Imagine being right about where a stock is headed and still losing every dollar you put in. That's not bad luck. For most options traders, it's the default outcome. Here's why. In 2024, India's market regulator studied millions of individual derivatives traders. The result? More than 91% of them lost money. Over a 3-year stretch, that number was 93%, and collective losses ran into the tens of billions of dollars. Options are sold as the fast lane to wealth, small bets, huge payoffs. But for most people, they're a fast lane to a zero balance. The good news, the reasons traders lose are not mysterious. They're predictable, repeatable, and avoidable. In the next few minutes, you'll learn exactly why the math quietly works against most options buyers. You'll watch one realistic trade play out dollar by dollar, and you'll see the specific mistakes that separate the 90% who lose from the 10% who survive. Let's get into it. Let's start with what an option actually is, in plain English. An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a fixed price before a fixed date. A call bets the stock goes up. A put bets it goes down. One contract usually controls 100 shares. The thing that makes options exciting is also the thing that quietly destroys most accounts: leverage. For a small amount of money up front, called the premium, you control a much bigger position. If you're right, the percentage gains can be enormous. If you're wrong, you can lose 100% of what you paid. Now here's the part nobody puts on the thumbnail. When you buy an option, you're not just betting on direction. You're betting on 3 things at once, and you have to get all 3 right. 1. Direction. The stock has to move the way you predicted. 2. Magnitude. It has to move enough. A small move in your favor often isn't enough to even break even. 3. Timing. It has to move enough before your contract expires. A stockholder only needs the first one. An options buyer needs all 3. That's 3 doors you have to walk through instead of 1, and every door you add cuts your odds. Why does magnitude matter so much? Because of the premium you paid. Say a stock trades at $100, and you buy a call that lets you buy it at $105. You pay $2 per share for that right. The stock now has to climb past 105 plus the $2 you spent, so 107, just for you to break even. That's a 7% move required before you make a single cent. The stock can rise, and you can still lose. And then there's the silent killer, time decay. The technical name is theta. Every option has an expiration date, which means every option is a melting ice cube. Part of what you pay for is time value, the chance the stock moves your way before the clock runs out. As each day passes, that time value drains away, even if the stock doesn't move at all. And it doesn't drain evenly, it accelerates as expiration approaches. Picture an option worth $5 with 30 days left. With the stock perfectly flat, not moving 1 cent, that option might be worth around $3.20 at the 2-week mark, about $2 with 1 week to go, and just 60 cents the day before expiration. Same stock price the entire time. You did nothing wrong on direction. You just got billed every single day for holding a melting asset. This is why options are called wasting assets. A share of stock can sit in your account for 10 years. An option is actively losing value while you hold it, like a coupon with an expiration date stamped on it. Now, let's bust a myth that actually causes a lot of losses. You've probably heard that most options expire worthless, so selling them must be free money. The real numbers from the main U.S. options exchange tell a different story. Only about 10% of options are exercised. Roughly 55 to 60% are closed out before expiration, and only about 30 to 35% actually expire worthless. So, most options expire worthless is simply false, and chasing strategies built on that myth is one way people lose. The honest takeaway is more useful. Options are a tool with a built-in countdown and a built-in hurdle. Used carelessly, the countdown and the hurdle do the losing for you. Keep those two forces in mind, the premium hurdle and time decay, because in the next section, we're going to watch them quietly drain a real account. Let's make this concrete with Marcus. Marcus is a beginner. He's got a $2,000 account and a strong feeling that a stock currently trading at $100 is about to run. He's probably even right. Let's give him that. Instead of buying shares, he buys options because that's where the big percentage gains are. He buys one call contract with a strike price of 105, expiring in 30 days. The premium is $2 per share. Since one contract controls 100 shares, that costs him $200 total. Right away, let's mark the line he has to cross. His break-even is the strike, 105, plus the $2 premium, so $107. The stock has to climb 7% in 30 days before Marcus makes a single cent. Hold that number, 107. Now, let's run the tape on expiration day. Scenario 1. The stock rises to 104. Marcus was right. The stock went up 4%. But 104 is below his 105 strike, so his option expires worthless. He loses the entire $200, a 100% loss on a correct prediction. Scenario 2. The stock climbs to 106. Even better call, up 6%. His option is now worth $1 per share, or $100. But he paid $200, so he's still down $100, a 50% loss. Right direction, decent move, still bleeding. Scenario 3. The stock hits exactly 107. The option is worth $200. Marcus gets his money back. After a 7% move in the right direction, he's broken even. Zero profit. Scenario 4. The stock jumps to 110, up 10%. Now the option is worth $500. Marcus paid $200, so he pockets $300 in profit. That's a 150% return. This is the dream the marketing sells you. So look at the full picture. For Marcus to win, the stock didn't just need to go up. It needed to go up more than 7% within 30 days. In 3 of those 4 scenarios, he was correct about direction, and in 2 of them, he still lost money. That is the trap in a single trade. Now, compare that to a boring investor who simply bought 100 shares of the same stock. Yes, it costs more up front, $10,000 instead of $200, but watch what happens. If the stock goes to 104, the shareholder is up $400, while Marcus is down $200. At 106, the shareholder's up $600, Marcus is still down $100. The shareholder profits on any move up, with no expiration date and no time decay eating away at the position. Here's the uncomfortable lesson. Leverage didn't make Marcus smarter. It just narrowed the range of outcomes where he gets paid. He traded a wide, forgiving bet for a narrow, unforgiving one, and the narrow bet has a clock attached. And we haven't even added the realistic friction. What if the stock takes 3 weeks to start moving? Time decay has already shrunk the option's value. What if Marcus bought right before an earnings announcement when option prices are pumped up? The premium can collapse the moment the news drops, even if the stock moves his way, because the expensive expectation he paid for has evaporated. Traders call that a volatility crush. Marcus didn't lose because he was stupid. He lost because he only thought about one of the 3 things, direction, and the market quietly charged him for the other 2. That's the 90% experience in a nutshell. In the next section, let's flip it around. The specific, fixable mistakes that put traders in that 90%, and what the 10% do instead. Almost every blown-up options account traces back to the same handful of mistakes. Here are the big 5 and the fix for each. Mistake 1. Oversizing the position. This is the account killer. New traders put a huge chunk of their money on a single trade because the potential payoff looks irresistible. The problem isn't one bad trade. It's that everyone, even the pros, hits losing streaks. If you risk 50% of your account on each trade, just 2 losses in a row leaves you down 75%. From there, you need a 400% gain just to get back to even. The fix: risk a tiny fixed slice per trade. If you only risk 2% each time, you could lose 10 in a row and still have over $1,600 of your $2,000 left. You stay in the game long enough for your good trades to matter. That single habit, small, consistent position sizing, is the clearest line between the 10% and everyone else. The fix: risk a tiny, fixed slice per trade. If you only risk 2% each time, you could lose 10 in a row and still have over $1,600 of your $2,000 left. You stay in the game long enough for your good trades to matter. That single habit, small, consistent position sizing, is the clearest line between the 10% and everyone else. Mistake 2. Buying cheap, far out of the money lottery tickets. That 40-cent option looks like a steal. But a cheap option is cheap for a reason. The market thinks it almost certainly won't pay off. A call that needs the stock to jump 15% to break even isn't a bargain. It's a coin flip where the coin is weighted against you. The fix: understand why an option is cheap before you buy it. Cheap usually means far away and unlikely, not undervalued. The 10% buy probability, not lottery tickets. Mistake 3. Ignoring time decay. Beginners buy short-dated options because they're cheaper, then hold them hoping for a turnaround, right as theta accelerates and eats the position alive. They give the trade no time to work on the contract least able to give them time. The fix: if you're buying direction, give yourself room, more time until expiration than you think you need. You'll pay more up front, but you remove the most ruthless force working against you, the clock. Mistake 4. Buying right before earnings, then getting volatility crushed. Option prices balloon before big announcements because everyone expects a move. Buy then, and you're overpaying for excitement. When the news lands, that inflated price deflates, and you can lose even when the stock moves your way. The fix: Know when your stock reports, and know that expensive option is a warning label, not a feature. Mistake 5, and this is the human one: revenge trading. Marcus loses $200, feels the sting, and immediately puts $400 on the next trade to win it back fast. Now he's doubling size at the exact moment his judgment is worst. The market doesn't owe him a comeback. The fix? A fixed rule you decide before emotion shows up. Preset how much you'll risk, preset your exit, and never increase size to chase a loss. We've got a whole video on the psychology of revenge trading. The short version is, the loss is the lesson, not the debt. So what does the 10% actually look like? It's not secret indicators or a magic strategy. They size small, so no single trade can end them. They know their break-even and their exit before they enter, both the price where they take profit and the price where they cut the loss. They respect the clock and buy themselves time. They understand the 3 hurdles: direction, magnitude, and timing, and they only take trades where the odds actually justify the bet. And maybe most importantly, they treat options as a precise tool for a specific job, not as a slot machine. Notice that none of that is about being a genius. It's about not beating yourself. The 90% mostly aren't defeated by the market. They're defeated by their own position sizing and their own emotions. Fix those 2 things, and you've quietly moved yourself toward the other side of that statistic. Here's the honest truth about this channel. We're not here to sell you a dream of overnight riches. We're here to help you understand how this stuff actually works, so you can make calm, informed decisions with real numbers behind them. If breaking down the math like this is useful to you, hit subscribe. We release a new breakdown every week, building from the basics up. Subscribing is the easiest way to make sure the next one finds you, and to keep yourself on the right side of statistics like the one we opened with. If you remember one thing from this video, make it this: when you buy an option, being right about the stock is not enough. You have to be right about direction, size, and timing all at once, while a clock ticks against you the whole way. The 90% forget that. The 10% build every decision around it. And the single most powerful fix isn't a fancy strategy, it's position sizing. Keep each bet small enough that no one trade can take you out, and you give your good decisions the time they need to add up. And the single most powerful fix isn't a fancy strategy, it's position sizing. Keep each bet small enough that no one trade can take you out, and you give your good decisions the time they need to add up. If this clicked for you, you'll want a few of our other breakdowns to go deeper. We've got a full video on revenge trading, the emotional spiral that turns one loss into 10. And one on the simple risk management rule that keeps your position sizes sane on every single trade. Watch those next, and you'll have the 2 skills that protect a beginner most: controlling your size and controlling yourself. And that's a wrap on today's topic. If you found this helpful, be sure to hit like and subscribe so you never miss a lesson. Have a question about what we cover today? Drop it in the comments below. I'll be answering the best one. If you want to dive even deeper, click on this next video right here, where we explore next topic. Thanks for learning with me today, and I'll see you in the next one.